Has anything changed since yesterday? What's different? It's like opposite here.
It's interesting. Tim talked about this. He's been right, by the way. As long as the Nasdaq has some relative strength, it's hard for the market to go down. And I think with yields moving the way you just illustrated, I mean, that's going to be supportive, whether you acknowledge it or not, or whether you accept it or not. I mean, that's what's going to happen. Those stocks are going to go higher. But what changed? I'll tell you what changed a little bit. The way the banks started rolling over around noon, 12:30 this afternoon, that changed, seemingly. Bank of America. But HYG, something that Karen's been short. I mean, this does not trade, and I'm not suggesting people should trade it, but that had a pretty precipitous drop around 12:30. It's something that doesn't move 1% in a day. Moved about 1% or 1.5% in a very short period of time. So my concern for a while has been when credit rolls over, well, at least for today, the HYG is telling a story.
No, credit, and look, if you look at high yield spreads, they are up about 110 basis points from the lows, which was only about a month ago. But as Guy said, look, the relative strength here, if you look at the triple Qs, so Qs over SPYs, as long as that works, I think the market works. It's because of this dominant position that these stocks have. This is 29% of the S&P or 30%, which I think it's peaked. I mean, I think we're not going to see this in 2 years, and we're definitely not going to see it in 10. But for now, again, it's meant almost 6% since Signature Bank, since Silicon Valley Bank. The dollar also has peaked. So you have real significant cross currents. I think a closing low in the 2-year, at least through the levels that we were even through kind of peak crisis a couple days ago, is very concerning for equities. But right now, positioning tells me, sentiment tells me, and I think the market goes higher.
All right, so I'll just say this, like to your point about the Nasdaq outperformance, to me it's problematic, and I know I've been saying that now for a week, and it doesn't make me feel better about the broad market, because if I look under the hood, it just tells me that the breadth is getting worse, right? So look at today, when Guy just mentioned the banks rolling over.
Breadth is terrible.
If the banks are the lifeblood of our economy, they look sick, right? And so what's gone on in the Nasdaq, particularly these largest names, feels unnatural, and it feels like the sort of crowding that could come undone very quickly. And then if I look at how energy rolled over today, if I look at how Russell 2000, so small cap stocks, and I get it, there's a lot of exposure there to financials, but like you just mentioned, Guy, credit, and the thing that you are short, high yield credit, right? And so what is going to be really like on the other side of whatever comes out of this banking situation? It's going to be access to capital, the cost of capital, and small cap companies here are going to have a harder time. They're going to be the hardest hit for this. So I just look at this and I say the Russell is telling you something. I say the banks are telling you something. I think the regionals are telling you that there's going to be a lot of equity that's not going to be worth a whole heck of a lot in the not so distant future. And I think that just some of these large money centers, I know we talked about this earlier in the week, there are problems lurking. I'm not telling you, you know what I mean? It's just obvious to me. Like, it's just really obvious to me. So we can start that again, I guess.
I don't know. I felt like we finished it at the time. But, I mean, to me, I don't think the money center bank's duration is really the issue. But I agree with you on the regionals. I don't feel like the storm is over at all, right? We haven't seen that credit contraction there. And we don't know what regulations. I got an interesting Twitter question about should banks sort of should regional banks proactively decrease their dividend just to shore up the balance sheet, even if they don't need to, which is sort of an interesting proposal, actually. Yeah. I think if everyone did it, then you could hide sort of behind it. But I do think there's more to come. We still haven't seen the resolution of First Republic, which I think is an important one.
Does it make you feel better or worse that Charles Schwab comes out and says we can cover with 100% liquidity if there's a complete run on the bank? If every single deposit walked out the door, they would be okay?
You know, for another institution, no, it would be the opposite effect, right? We saw that at Silicon Valley Bank when everything was absolutely fine there. I think, you know, that Sarah did that interview with the Schwab CEO, which I thought was excellent, and I thought he did a very good job of just calming everyone down. I think him putting up some real money, 50,000 shares bought, I don't know, around here or so. I think they're doing a better job, and that customer base, I think, loves Schwab and feels comfortable there. But in general, when a bank CEO says that, that's not good.